Hi everyone, this is Sean Lee from Unwavering Capital. TSMC stock has generated 51% return for me, generating 30% alpha since my long pitch. Let's explore recent developments that have occurred since Q2 2025 earnings. TSMC stock slipped 2.5% in Taipei with Nvidia reporting soft data center revenue and China risks. But investors should shift their attention from Nvidia merely missing data center revenue by $100 million to Jensen's $3.5 trillion in AI infrastructure spend by the end of the decade forecast. Upward capex revisions by hyperscalers support his remarks. For instance, Google originally planned $75 billion in capex for 2025, but is now raised to $85 billion. Meta has also recently refined its capex guidance from a 64 to $72 billion range to a 66 to $72 billion band. While bears point to low ROI on AI spend to argue that cloud providers will moderate their capex, I would claim that AI revenues is in the early stage of long runway growth, and that positive ROI would eventually manifest in the future, justifying their continued increase in spending. Microsoft has disclosed that AI revenue has surpassed $13 billion annually, which is 11% of Asia revenue and 16% of 2025 capex, representing a sharp 175% year over year growth. Projections suggest that its fiscal year 2026 capex could exceed 85 to $100 billion. Meanwhile, analysts estimate that AI workloads will be $27 billion in 2025, which is 21% of AWS revenue and 27% of 2025 capex, growing to $42 billion by 2027. For Google, forecasts suggest that AI revenue will be $21 billion in 2025, which is 38% of Google Cloud and 25% of 2025 capex. Implications of the US government acquiring 10% stake in Intel on TSMC. Investors are betting that the US will push fabless consumers to use Intel Foundry. Report that the US will invest $9 billion in Intel added $24 billion to the struggling chip market's market value. This has Intel trading at 53 times 4 PE, the highest multiple since the dot-com era. The rise in multiples suggests the market sees Intel Foundry becoming a credible rival to TSMC. While TSMC bulls are dismissing the negative implications of this development will have on the company, I take a more nuanced and cautious view. Yes, Intel has lower yield, inherent conflict of interest, wrong priorities, and an inferior performance and consumer service than TSMC. However, customers who previously refused to go with Intel, given the possibility that its foundry will not be viable again, now have a credible reason to choose the American manufacturer with government's guarantee of Intel Foundry's existence. Moreover, Trump may implement incentives to successfully pressure tech companies to participate in a potential Intel Foundry recovery, as it did with TSMC. However, some market loss for TSMC would not be an outright negative. In the current geopolitical environment, the added cost of retaining a 9% market share in leading edge nodes may outweigh the benefits for TSMC. I believe that having an illusion of choice for customers may be a more favorable development for TSMC, as it can lessen tariff threats and governmental pressure for more reshoring to the US. In the long term, however, it could be a good news for TSMC that the US took a stake in Intel. Government's involvement in private business almost always ends badly. Furthermore, Intel's non US business, which accounted for 76% of its revenue last year, may be negatively impacted by the US government being the largest shareholder, as this could subject the company to additional restrictions such as foreign subsidy laws in other countries. Intel may also cease to receive grants from other governments. Given the high likelihood of these events occurring in the future, TSMC may be awarded a higher multiple. July sales results was 23% month to month and 26% year over year for TSMC. This result puts the company ahead of plan with 34% of expected Q3 sales. This strong result is due to continued strength in smart platforms, N3, especially for Apple, and stable momentum in HPC. Given that similar strong starts have resulted in the company reporting upside in a series of recent quarters, my Q3 25 exceeding management guidance of NT $922 billion to $957 billion seems reasonable. With the recent uptick in iPhone unit forecasts and Apple's recent relief from tariffs, TSMC could be seeing some upside for 4Q25 and 1Q26 revenues, which could lead fiscal year 2026 revenues to approach 35% year-over-year growth in USD terms. Now, moving on to Tesla signing a $17 billion multi-year deal with Samsung to make its next generation A16 chip. TSMC's US traded shares declined 2% on the news, wiping out $16 billion in market value. I believe it was an overreaction given that the impact on TSMC will be only 1% drop in revenue. Please keep in mind Tesla is in a top 10 customer for TSMC and has historically partnered with Samsung for most of its wafer demand for HW3 and HW4. But at the same time, I'll continue to monitor the growing trend where customers are increasingly seeking multiple foundry sources amid geopolitical risks and capacity concerns. I still believe that TSMC will have 92% market share in the first wave of N2 products. Moving on to risks. US production costs are 27 to 45% higher according to KGI. According to their calculations, production costs for N4 were 100% higher in the US than in Taiwan initially. They allege that with yield improvements and debottlenecking, the cost gap can be narrowed to 45%. They also argue that if the Arizona fab is scaled up to the same as Taiwanese facilities, the cost gap could be reduced to 27%. KGI also claims that the gross margin in the US is only 30% versus 59% in Taiwan. They cite three major factors of higher US production costs: higher construction costs, and higher labor costs, and through backend tools and others. However, I forecast higher depreciation costs for investing in advanced nodes and building US facilities. I also believe TSMC has strong pricing power to pass on the increased costs to customers. That said, I do predict continued gross margin contribution for TSMC. However, it should through into half 25 and move up in 2026 with price increases and less dilution from N3. Moving on to valuation. My base scenario target is derived from 21 times next 2 months EPS. I believe a 9% premium to its 5-year average multiple will be supported by positive revenue growth revision, driven by sustained strong demand for its AI products. Additionally, the risk associated with Section 232 tariffs has now diminished, not just for TSMC, but also to its key customers such as NVIDIA and Apple, which should warrant the stock a premium multiple. Become a paid subscriber to my Substack to get access to a fully integrated, differentiated, and dynamic TSMC and DaVita financial models that are updated post Q2 25 earnings results. All key assumptions have been verified through my extensive primary research, and you can adjust them to your liking to understand how they impact the price target. Essentially, you will understand how an ex-Citadel hedge fund analyst built financial models.